What if I told you that most professional investors fail to beat the stock market over the long run? Millions spend countless hours picking stocks, following financial news, and trying to time the market. Yet many still underperform a simple index fund. In a random walk down Wall Street, legendary economist Burton G. Malkiel explains why successful investing isn't about predicting the future. It's about following timeless principles. Here are 7 powerful lessons that can help you build long-term wealth with less stress and better results. This is Wisdom Lab. Let's begin. 1. The market is hard to beat. Imagine competing against millions of investors, hedge funds, analysts, and AI systems, all searching for undervalued stocks. That's today's stock market. According to Malkiel, stock prices already reflect publicly available information, making it extremely difficult to consistently find bargains. This means chasing hot tips or trying to outsmart the market usually leads to disappointment. Lesson: instead of trying to beat the market, become the market. 2. Invest in low-cost index funds. If beating the market is so difficult, what's the smarter strategy? Buy the entire market. Index funds own hundreds or even thousands of companies, giving you instant diversification while charging extremely low fees. Over decades, these savings in fees compound into significant wealth. Many actively managed funds charge high fees but still fail to outperform simple index funds. Lesson: lower costs often mean higher long-term returns. 3. Time in the market beats timing the market. Many investors wait for the perfect moment to invest. The problem? Nobody consistently knows when markets will rise or fall. Missing just a handful of the market's best days can dramatically reduce your lifetime returns. Instead of guessing, invest consistently regardless of market conditions. Whether prices are high or low, regular investing allows you to benefit from long-term growth. Lesson: successful investors stay invested. They don't try to predict tomorrow. 4. Diversification is your best protection. Putting all your money into one company, even a great one, is risky. Unexpected events can destroy even the strongest businesses. Malkiel recommends spreading investments across different industries, company sizes, and even countries. Diversification doesn't eliminate risk, but it greatly reduces the impact of any single investment going wrong. Think of it as building a safety net for your portfolio. Lesson: never let one investment determine your financial future. 5. Ignore market noise. Every day, financial media screams, "Markets are crashing. This stock will double. Sell everything." Most of this noise encourages emotional decisions. Malkiel reminds us that short-term market movements are largely unpredictable. Successful investors ignore the daily drama and stay focused on long-term goals. Remember, headlines make money for media companies, not necessarily for investors. Lesson: don't confuse entertainment with investment advice. 6. Asset allocation matters more than stock picking. One of the biggest factors behind investment success isn't choosing the perfect stock. It's deciding how much money goes into stocks, bonds, and cash. Your ideal allocation depends on your age, financial goals, and tolerance for risk. A young investor may hold mostly stocks, Someone nearing retirement may prefer a balanced portfolio with more bonds. The right allocation helps you stay invested during market downturns. Lesson: build a portfolio that matches your life, not someone else's. 7. Investing is a marathon. Real wealth isn't built overnight. It's built through patience, consistency, and compound growth. The investors who succeed aren't necessarily the smartest. They're the ones who avoid emotional mistakes and stick to their plan year after year. Small investments made consistently can grow into remarkable wealth over decades. As Malkiel emphasizes, discipline usually beats brilliance. Lesson: stay patient. Let time become your greatest investment partner. Let's quickly recap the 7 key takeaways from a random walk down Wall Street. 1. Markets are extremely difficult to beat consistently. 2. Low-cost index funds are powerful wealth-building tools. 3. Time in the market beats timing the market. 4. Diversification reduces unnecessary risk. 5. Ignore short-term market noise. 6. Focus on smart asset allocation. 7. Patience and consistency create long-term wealth. Investing doesn't have to be exciting. In fact, the less exciting it is, the more successful you may become. If you found these lessons valuable, hit the like button, subscribe to Wisdom Lab, and share this video with someone who wants to become a smarter investor.